Hello and welcome to the sessions on QuickPrep. In this particular video series, we are going to talk about something called as corporate finance. Now, corporate finance at level 1 is pretty small a topic as far as the exam weightage is concerned. But what is critical about this topic is the fundamentals that you're going to learn here are going to be useful in a lot of other modules. So your capital budgeting, cost of capital, your dividends, some of the very critical pieces here. So what we thought is at FinstudyClub to give you a quick overview of all the formulas which are there, the critical and the important formulas, so that you can just have a quick overview of the entire course in absolutely no time. So here I am starting with capital budgeting. Capital budgeting, one of the numericals, numerically oriented readings in corporate finance, is one of the A category element, which is very critical. So there are out of 6, there are about two very critical A category readings, which is capital budgeting and cost of capital. So allow me to take capital budgeting first. So in capital budgeting, we're trying to evaluate a particular capital expenditure, should we do or not. So the question that we are grappling up with, a yes or a no, and to do that we got to compare the benefit with the cost. Now this comparison happens with 5 different techniques. So the techniques that you see here are those 5, essentially the benefit versus cost comparison. Each of these techniques is a mathematical construct, individual and independent of others, and will have a different unit. For that matter, net present value will have a dollar amount as the unit. So the final value, a benefit or a cost, so net benefit, so to speak, is going to be in dollar terms. Internal rate of return is actually a percentage, and so is your the average accounting rate. Profitability index is an indexed feature, so you would have 1 point something coming as an answer. Okay, and there is another called as payback period, which is more of a conceptual thing, that in how much time does your investment come back. So that's an easy thing. So talking about the NPV first. So here you're going to talk about all the investing timeline. So you're going to plot all your future inflows and your outflow today. So your outflow today is with a negative sign, and all the inflows with a positive sign, and you discount them using your WACC. WACC is your weighted average cost of capital, applicable to this time period. So it doesn't matter where you are right now, how old you are, doesn't matter. What is the funding that you're raising for this particular capital expenditure? The proportionate cost for that particular funding is called as your WACC for this particular discounting thing. So this outlay is what we're referring to, is your present value of cash outflow, which is typically at T0. Okay, so we are taking a conventional cash flow pattern where the outflow happens only at T0. In a non-conventional pattern, although we don't expect it to come at level 1, there might be an outflow happening in a particular future years, in which case the calculation remains absolutely simple there as well. Whatever are the outflows, just discount them and add it to this particular element. Okay, fantastic. So just keep in mind that the rate here that you're using to discount is your WACC. Okay, it is not the return that you're earning, but the return that you're giving to someone else, the capital providers. Coming to the second point, and this is where a little bit of confusion crops up. The internal rate of return, simply put, it is a return that you earn. It is not the return that you pay. So this needs to be distinguished with WACC. And in fact, this becomes the decision point as well. So if I have borrowed, as a business, if I have borrowed money from my capital providers at 8%, this is the minimum return I would like to earn on my assets. So this 8% will be compared to the returns that I'm going to earn on my assets, on which I would be able to take a final decision point of 4%. If this is a positive number, I'm going to go ahead, otherwise not. Okay, so internal rate of return, it's a mathematical number, it's a mathematical construct wherein it is that hypothetical rate at which my present value of cash inflow is equal to the present value of cash outflow. Keep in mind that these inflows and outflows that we are referring to is of the investing timeline. By investing timeline, I mean the project. Okay, so these are the cash inflows and outflows, and you hypothetically try and equate them. So that's your IRR. The third is a very bad technique called as average accounting rate, which is not based on cash, nor does it have any time value of money. So it says if my project is going to run for 3 years, what is going to be my average book value of the asset? So now do you see that there is a lot of accounting adjustments which is being referred to here is book value, or let's say, so it will be subject to something called as depreciation as well, so on and so forth. And the numerator of that is the total profits made in the 3 years. By the way, PAT, not CFAT. So it is a total profit divided by the number of years. So it's like the per year profit divided by on an average investments every year. So it's a very, very bad ratio. Doesn't take into account the cash, nor does it take into account the time value of money. Comes the fourth concept of profitability index, which is very similar to net present value. The difference is that NPV is subtractive and this is divisive. So what we do is in NPV, we try and calculate PVCI minus PVCO. However, in case of profitability index, we try and take this PVCO to the denominator. So what we get typically is PVCI divided by PVCO. So let's say, so I have $110 and this is $100. So I'm going to get 1.1. It simply means unspoken denominator is 1. So it simply means that by putting a $1 of investment, I'm being able to generate 1.1. So this 0.1 is the delta, which is the corresponding figure for NPV. So I can also therefore refer to PV profitability index as, let me break this into two parts, PVCO plus NPV upon PVCO. So this becomes 1. So I get a final number of 1 plus NPV upon PVCO. So it's just the same formula which is being referred to in a different context. Comes the second reading, very, very critical, cost of capital, one of the longer readings, one of the important readings, and therefore an A plus category reading. So it talks about different individual costs. How do you calculate the different individual costs? The way the reading materials have been published is they start with WACC. My suggestion always is to start with individual cost of capitals, because unless you know how do you calculate individual cost of capital, you'll not be able to put these numbers here. So let us go in the order in which, let's say the study material published. So assuming that you know how to calculate these return of debt, the return of preferred, and return of equity, you just put them into different weights. And obviously the fundamental is absolutely clear that the sum total of all the weights have to be 1 or 100% in any mathematical form that you would like to. Keep the taxation angle into mind, that it's only the cost of debt that needs to be made after tax. Cost of preference and equity is already bases the dividends and the returns, which were anyways at an after tax level. Now there is a confusion that crops up when we talk about the debt to equity and the total ratio. So sometimes it says that the debt to equity is, let's say, 3. Now, how do you decode that into and convert it into weight? An obvious common sense thing is to make it, 3 times to 0.75 and 0.25. But how do you get this so, quickly? Now, the way I tell my candidates is debt upon equity. So divide it into 3 parts: debt, equity, and total. So if debt is 3, equity is 1, so total must be 4. So the weight is not the relation of debt to equity. The weight is actually the relationship of debt with the total and equity with the total. So therefore, you have 3 divided by 4 giving you 0.75 and 1 divided by 4 giving you 0.25. Please never, the weights should not be intra the capital structure. It should always be of a particular the source of capital with the total. Okay, keep that in mind. Coming to the individual cost of different sources, the cost of debt or cost of preferred, see, the fundamental is exactly same. So there is a borrowing timeline that you have plotted, and the rate of that borrowing timeline is your cost of capital. Now here I would like to again take and raise up the issue of IRR. IRR is also the rate, but it is the rate of the investing timeline, as I told you. However, cost of capital is the rate of the borrowing timeline. So if let's say I have borrowed $100, there is a plus sign for me at T0, and I am giving someone 115 after 2 years. So what is the rate? So this is an outflow for me. So what is the rate which equates PVCI to PVCO? Now this has nothing to do with your IRR. Now this is the relationship that the business has with the debt providers. There would be an independent relationship that the business would have with its preferred providers or equity provider for that matter. So all these relationships are independent relationships. So when we're talking about the cost of preferred, so let's say we borrowed $100 at T0 from the preferred providers, and To them a year later I have paid, let's say, 123. So their rate of this timeline will be a little different, and will be different than the cost of that share I'm going to get. So every individual source of capital will have their respective, what we call as a borrowing timeline. The borrowing timeline, keep that in mind. Okay, and for IRR what you need is an investing timeline. Investing timeline is nothing but the timeline of the money that you are investing into. So it has an outflow at the beginning and followed by a lot of inflows. The borrowing timeline is exactly the opposite. So it has inflow right now followed by a lot of outflows. Okay, so the value of everything, the value of preferred stock, etc., etc., the cost of preferred stock, this is a simple formula. So the present value is equal to the future cash flows divided by the rate. Now let me put few values. Future cash flows are the preference dividend. Okay, this is cost of preferred and this is the intrinsic value of preferred. Now out of three, any two might be missing and you might have to calculate the third angle. So we are not kind of mugging up the formula as such. We're trying to just create a good construct so that should there be a question from any front, you would be able to. Now coming to cost of equity, which is obviously the most meaty and most critical, you can calculate the cost of equity in three different ways. The first is the capital asset pricing model. This is something that you would also talk about in your portfolio management, in which you are trying to justify a required return on the basis of the risk which is involved. So this is the average risk premium of investing into equity. Multiply that by the sensitivity, the unique sensitivity of that stock, which is represented by beta, which is a systematic risk, because the people who the founders of these model believed that it's only the systematic risk which should be taken into account, because at a portfolio level the unsystematic risk has already been diversified. So there is no compensation that should be given to the investor for that. And obviously this becomes the unique risk premium to be added to the base rate, the risk-free rate, which the rate at which the rate which everyone should get even without taking a risk. Coming to the second point was dividend discount model, which is again based on time value of money. Now, this was created by Myron Gordon, one of the very, very renowned financial economists, who said that I'm going to assume that the dividend growth is going to be constant. Now, obviously, it is one of the very big criticism that the constant growth of dividend, and obviously, what is going to be the rate of that growth? Can it be more than GDP and less than GDP? Can it be so? So all that thing set aside, but it was nevertheless a very good way to break the deadlock which was happening, because we are unable to calculate the set pattern of the equity dividend, because unlike preference, they are not fixed, and the timing also is not. So until and unless there is some kind of a sanctity in the time series that you're plotting, the mathematical, arithmetic and geometric progression would not be able to give you a present value. So Gordon said, let me assume the constant growth, and here I am with this formula. So the present value of a perpetuity which grows at a constant rate is the first annuity, the first term, divided by let's say 1 minus the constant ratio. And if you utilize this mathematically, you get this formula d1 upon k minus g. Obviously the limitation, as you can yourself see, is the growth has to be less than the cost of equity, otherwise denominator is going to become a negative figure, and you can't have a share value with negative. So the lowest value that it can get is 0, it being a limited liability concept. Okay, just a bit on that. So it is again rearranging the formula. So d1 upon ke minus g is equal to p0. So if I have to just rearrange that, I'm going to get the formula that you write here. So it's not a rocket science. Sustainable growth rate, the growth rate that the dividend will experience, is actually a matter of how much is the portion that you are retaining. Multiply that by the earnings that you're going to get on that retained portion. So it is actually a a combination of both of them. So and this can also be return on the retention rate can be made as 1 minus dividend payout ratio. So these are some of the formulas that you have to kind of work around. The third method to calculate the cost of equity is through bond yield plus risk premium approach, in which case we are saying that the cost of equity of a particular company C1 will be equal to the cost of bonds for that particular company plus the average risk premium of investing into equity versus bonds. Now this average risk premium is going to be consistent and same for all the companies in that particular economy stroke market, because here there is no company specific issue. If at all there is a company specific issue, is being built into the bond yield. So this is exactly what is equal to your cost of debt plus the average yield. Answer by all the three approaches, bond yield, dividend discount and CAPM might be different, and you have to also see the fitment as to information given according to which model will actually justify as to which model will you be able to use in the exam. So if let's say beta is given, that means the exam is hinting you to use CAPM. If constant growth is given, then the exam is hinting you to use dividend discount model. If cost of debt is given, so likewise there's a third model that you have to kind of use. Now coming at the break point, and this is not equal to break even point, something which you have to keep in mind. The break point is that portion of capital at which, so if I have to plot the total capital here and I have to plot the WACC here, now here if I plot the WACC curve, it's going to be upward sloping. The reason being that more the amount of capital that I borrow, keeping the capital structure same, the portion of the debt will also go up. So every subsequent debt is going to come at a higher cost because of the increased leverage, and the cost of equity would also go up because of the degree of financial leverage, as a result of which the WACC is going to go up. Now this is it's not a smooth curve. That's what you have to understand. There are slabs which different capital providers give you. So the bank will say that if you got to borrow from 0 to 100 million, I'm going to charge you 4%. That means between this, the curve is going to be flat. The moment your borrowing goes up, the curve is going to, let's say, change. The rate is going to change. But what you have to understand is that the reason for change in the curve is not the total capital, but one of the sources. What I'm trying to say is the slabs given for cost of debt and slabs given for cost of equity, both put together will decide at how many levels has this break come in. So this break point is the amount of total capital at which the WACC curve, which was flat so far, suddenly changes its tangent and then again becomes flat. So keep that in mind. So if let's say debt is so taking this particular case, so it is at $100 that the debt cost is going to change, and debt is about, let us say, let's assume 40% of my total capital structure. So if debt is 40, if debt is 100 and the percentage is 40, the break point is going to come at 250, because when my total capital is going to be 250, it is at that point where my debt is going to be 40% of that, which is 100, and it is at that point that my cost is going to go up from 4% to whatever, 5% or whatever else. So keep that in mind, that your break points are the values of the total capital, but the reason for that change or let's say the reason for those break points are the individual cost. Now there is a concept called as pure play. And pure play is an interesting concept wherein we are trying to say that if a new company ventures into some other industry, there has to be a lot of learnings that he has to get. And whatever has been the erstwhile, the so far situation will not be helpful. So we are talking about the beta per se. So if there is a capital budgeting exercise that I have to do, so let's say an automotive company wants to get into pharma. So the beta of automotive will not be helpful. The reason being that the pharma will have a different industry risk. So we try and look at a proxy, and from let's say we try and look at another company called as Pfizer. We will decode the industry out of it. So we will beg your pardon. So we'll modify this particular beta so that I can use it for my particular project. So how do I do it? I would remove the financial risk from this beta of the proxy, make it an industry beta per se. This process is called as unlevering the beta. Unlevering as in removing the effect of the leverage. And I'm going to borrow it and apply my own financial structure. That's called as levering the beta. Okay, so a simple formula that I can give you is overall beta, or the unlevered beta, is equal to the beta equity. Now you would yourself understand that your beta equity will be higher because it has the debt risk also. It will be equal to equity plus debt 1 minus t. So keep this formula in mind. So if you have to arrive at beta overall, so this becomes the multiplier. If you have to arrive at beta equity, then the same multiplier will be the reciprocal of it. That's the only thing. So both the two equations are exactly the same. It's just that the what you have to find out is changing. Okay. Then there was a concept of country risk premium, in which we said that an investor, if investing into some other underdeveloped or relatively less developed country, would need some kind of an extra risk compensation to be, let's say, excited to do that. So that risk compensation is difference between the bonds of both the government. So if, let's say, a US investor, the the treasury bills are trading at, let's say, 3%, and he's investing into Brazil where the rate is about 11%, that means 8% extra return that he's going to get while he invests into Brazil. And obviously this is commensurate with the risk perception that the US investor would have for Brazil. But keep that in mind that this is at a bond level, that too at a government bond level. You need to equitize that, because ultimately you have to calculate it from the point of view of equity. Return of equity is something that my investor is willing to calculate. So how do I equitize it? By placing a standard deviation of bond here and by placing a standard deviation of equity here. So an equity index ka standard deviation and a bond markets ka standard deviation is going to put here. So keep that in mind. So in simple form, we are equitizing this 8%. Coming to a very, very small topic which is called as leverage. Leverage is an easy bit. So you're maximizing your input to get a much greater output. So leverage is actually the amplification that you get. So the entire income statement is divided into sales to EBIT to finally your EPS. So the first half is operating leverage, in which you get a formula like that. So percentage change in EBIT divided by the percentage change in sales. Now when we say units sold, we are assuming that your selling price is constant. So the better thing to do is to, let's say, take sales in dollar values here and calculate the percentage basis that. The second half of the formula is going to be the degree of financial leverage, where a percentage change in net income or EPS is being referred to in context of the percentage of the operating income. Now what you have to understand also is that to calculate the percentage change, you need 2 years figure. So let's say 100 becomes 120 and the percentage change is 20%. If the question doesn't give you that, the question gives you only 1 year's figure, then also you can calculate the same values a little smartly. So you have your sales minus variable cost giving you contribution, giving you operating fixed cost, giving you EBIT. Okay, so we're talking about the operating leverage, which is happening because of this operating fixed cost. So the shortcut formula is anything above it is going to become the numerator here, and the thing below it is going to become the denominator here. So that's broadly the idea by which you can create these shortcut formulas. Similarly here, the financial leverage happens because of the interest. So anything above interest is your EBIT, which is essentially here, and anything below interest is your PBT, which is essentially here. So that's how you can kind of calculate these shortcut formulas. And degree of total leverage, again, is no brainer. Your DOL multiplied by DFL. Please do not add. It's always multiplicative. Is going to give you the DTL or DCL, combined leverage or total leverage, as the case may be. The same point that I had measured earlier, that it's not break even point when we were referring it to under cost of capital. Remember, we referred it to something called as a break point. Now what we are referring right now is a break even point, which is a number of units that I got to sell so that I can recover all my cost. Now broadly, there are two fixed costs that I can worry about. The first is only operational. I don't worry about the financial cost, or I worry about operational plus financial. So these are the two levels at which my break-even point would also be calculated. Obviously, I need to sell much more number of units here because the additional fixed cost also needs to be calculated. If the additional fixed costs are not there, that means my total cost and only operating cost are same, then my break-even point and operating break-even point, these two are also going to be same. Okay, just a hypothetical point. Coming to working capital management, one of the, so to speak, a B category, as far as importance is concerned, not very critical. There are a lot of ratios which you've already done in your FRA. So there are current ratio, quick ratio. Now these are all that you've done in your ratio analysis. These are all related to working capital, the operational assets and liabilities. So what do you include in your operation current assets? Your cash, your bank, your marketable securities, your account receivables, your inventories, and your prepaid expense. And your current liabilities typically are the outstanding salaries, your purchase, the payment that you have to do, etc., etc. So quick ratio is trying to find out the repayment capacity, but in a little shorter span of time. So while current ratio will have all the current assets to take care of the liabilities, the quick ratio will have only, let's say, top three. So cash, short-term marketable security, and receivable. It will not have inventory, and it will also not have the prepaid expense. Okay, then these are the turnover ratios. I'm not going to get into each one of those. Is exactly the same that you have done in your FRA. So the number of days of inventory, the payable turnovers, so on and so forth. Okay, now operating cycle is something that is critical from an exam standpoint, which is equal to the inventory holding period plus the debtor holding period. So when we deduct the number of days payable from it, that means you're netting it off. Therefore, you get a net operating cycle. It is also called as the working capital cycle and the cash conversion cycle. All the three names are given to the similar, the number of days that we are talking about. Now comes the little confusing part in the working capital management. So this is related to the towards the back end of your particular reading, where we're talking about the short-term borrowings and investing. So these are different places, different formulas, different structures according to which you will have to just park your funds, or let's say borrow your funds in a particular context. So when we're talking about money market, now money market yield is typically on the basis of 360 days globally. So let me just put a to put a bit of context here. So there are different number of days in month and divided by days in year. So broadly there are three notations which is prevalent in the fixed income securities. So one is 30 upon 360, the other one is actual upon actual, and then it is actual upon 360. Now these are the, for convenience it has been decided. So any government bond is going to follow this. Any corporate bond typically follows this notation, and the money market follows this particular notation. So you see here that the number of days is going to be actual, but 360 is going to be used, not 365. However, in context of a corporate bond, or let's say the government bond, so it will, so every unit will have a different notation. My only request is you got to be a little more kind of sharp in your memory to be able to recall on the basis of that particular day. So if let's say we're talking about a treasury bill, then a treasury bill is typically on the basis of discounts that you get. So you have $100 today being issued for 98. So 2 upon 98 will give you the yield. So all that calculation and you have done in your fixed income. So it's just like the the same point being repeated here. So the discount percentage which you have been referring to is so on and so forth. So I don't need to tell you exactly what exactly needs to be done as far as these are concerned. Then again, the different sources of borrowing from, let's say, short-term funding from bank and all of that. So you have different line of credit cost, the cost of that. So you charge interest and your commitment fees, and you have to divide it by the loan amount. Now what you have to remember in these formulas is what is the denominator and what is the numerator. Sometimes the denominator is going to be the full loan amount, sometimes it's going to be the interest will be deducted at source, and let's say you borrowed 100 and for 1 year, for which the interest is turning out to be $8, the lender is going to give you 92 itself. So the net proceeds is 92. So let's say the banker's acceptance cost, what you finally get is the net proceeds in hand. So the cost that you will have to calculate is like this. However, in case of line of credit cost, the final loan amount is 100, the interest is going to be 8, and let's say commitment fee is 1. So you now be able to appreciate the difference in the denominator much well. Okay, so we have another thing called as loan amount minus the interest. So exactly, this is the same thing that we are talking about here. So this again becomes your net proceeds. So this appears to be a little confusing, but do them a little patiently. So I think it's been a good quick rapid fire round of all the formulas, would give you some sense of how things have been taken into account. The other readings that you see are very theoretical in nature, and they're a little more conceptual. So there are not many formulas in which. So we thought of kind of skipping it for the moment. So all the best, and do very well in the exam. Thank you.